Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ENERPAC Tool Group Corp. Quarterly Report. ENERPAC Tool Group Corp. offers a diverse range of industrial products and solutions across various markets. The company's product portfolio includes branded hydraulic and mechanical tools, such as cylinders, pumps, valves, bolt tensioners, and specialty tools. They also provide high-force hydraulic and mechanical tools for heavy lifting technology solutions. In addition to its product offerings, ENERPAC Tool Group Corp. provides services and tool rentals to various industries, including infrastructure, industrial maintenance, oil and gas, mining, civil construction, and alternative energy. Their services include maintenance and manpower support, as well as tool rentals for specific projects or operations. The company markets its products and services under several brands, including ENERPAC, HYDRATIGHT, LARZEP, DTA The Smart Move, and Simplex. With a global presence in over 10 countries, ENERPAC Tool Group Corp. has established itself as a leading provider of industrial solutions and tools for various industries. ENERPAC Tool Group Corp. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $6 billion. ENERPAC Tool Group Corp. trades at a lower price-to-earnings ratio of 22 times and a higher price-to-book ratio of 4.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline can be identified through a review of the company's financial performance. On the positive side, product sales growth, organic product sales growth, and growth in the IT&S segment product business have contributed to an increase in revenue. Specifically, product sales grew by $9.3 million, or 6%, while the IT&S segment saw a 10% increase in product business. On the other hand, several factors have led to a decline in revenue. Supply chain issues and failure to estimate customer demand properly have hindered growth. Additionally, economic downturns at both the domestic and international levels have negatively impacted sales. Furthermore, decreased demand from customers in the oil and gas industry has also contributed to the decline. The IT&S segment service business saw a significant 22% decrease, while overall service sales declined by $8 million, or 13%. These factors highlight the importance of effective supply chain management and accurate demand forecasting in maintaining revenue growth. Net income experienced a significant decline in 2026 compared to the previous year. The net income decreased by $4.6 million in Q2 2026 and $7.2 million in H1 2026. Furthermore, it dropped by 16.9% in 2026 compared to 2025. Profit margins also underwent a decline in 2026. Gross profit margin decreased from 50.3% to 46.4% in Q2 2026, and from 51% to 48.6% in H1 2026, indicating a substantial drop. Operating profit margin followed suit, decreasing from 21.1% to 16.2% in Q2 2026, and from 21.3% to 17.9% in H1 2026. The reasons behind these changes are not explicitly stated in the provided summaries. However, it is clear that both net income and profit margins experienced a decline in 2026, with gross profit margin being particularly affected. The company's financial performance is a significant indicator of its overall health and stability. A key metric to assess this is the generation of positive operating cash flow. According to the extracted summary, the company has successfully achieved this milestone. Page 6 of the report highlights that cash provided by operating activities, $29,027, 2026, which clearly indicates a positive operating cash flow. This figure demonstrates that the company's core operations are generating sufficient funds to cover its expenses and investments. Furthermore, page 27 confirms this with net cash provided by operating activities, $29 million, 2026, reiterating the company's ability to generate positive operating cash flow. In conclusion, the company is indeed generating positive operating cash flow, which is a testament to its financial stability and resilience. This achievement is a significant indicator of the company's ability to sustain its operations and invest in growth initiatives. The company's debt level has undergone some changes between 2025 and 2026. While the current maturities of long-term debt have increased from $7,500 to $10,000, the total long-term debt has actually decreased from $182,168 to $177,251. This suggests that although there is a slight increase in short-term debt obligations, the overall level of long-term debt has been reduced. In terms of interest expenses, there are no significant changes reported. The amortization of debt issuance costs remains unchanged at $293 for both 2025 and 2026. Additionally, a potential 10% increase in variable rate debt would only result in an increase of less than $1 million in financing costs. This indicates that the company's interest expenses have not changed significantly between the 2 years. Management is optimistic about the company's future prospects, outlining a clear strategy for sustainable growth and returns. The long-term goal is to achieve above-market growth in core business areas while expanding margins. To achieve this, the company will focus on organic growth through key vertical markets that benefit from long-term macro trends. A customer-driven innovation approach will be taken, with an emphasis on digital ecosystem expansion and entry into emerging markets such as Asia-Pacific. Operational efficiency techniques will also be employed to optimize selling, general and administrative expenses, driving margin expansion. Cash flow management is critical to achieving the company's objectives, with a focus on allocating cash flow and revolver availability to fund growth initiatives. The company will also manage foreign currency risk through hedging transactions to mitigate potential adverse impacts of exchange rate fluctuations. Overall, management is confident in the company's ability to execute its strategy and achieve long-term success. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which the company has done consistently over the past 2 years. In 2026, it paid out $2,119, and in 2025, it paid out $2,167. This demonstrates the company's commitment to sharing its profits with its investors. In addition to paying dividends, the company has also been active in buying back shares from the market. Over the past 2 years, it has spent a significant amount on share buybacks, with $65,924 being spent in 2026 and $14,555 in 2025. This strategy not only reduces the number of outstanding shares, but also boosts earnings per share for existing shareholders. Concerns about supply chain disruption and inventory buildup have been raised in recent times. Supply chain issues can lead to increased costs or delays in fulfilling orders, as seen with logistics challenges such as global freight capacity shortages. This can have a significant impact on businesses that rely heavily on timely deliveries. In addition to supply chain disruptions, there is also concern about inventory buildup. As shown by the data, inventory levels have increased from 12% of sales to 15%, indicating a potential issue with excess stock. Maintaining minimum levels of inventory through agreements with suppliers can help mitigate this problem, but it may not be enough to address the underlying issues. The increase in inventory levels suggests that businesses are holding onto more stock than necessary, which can lead to wasted resources and reduced cash flow. This is a concern for companies looking to optimize their operations and improve efficiency. That concludes the financial summary for ENERPAC Tool Group Corp. Feel free to comment below, and I will be happy to answer them when possible.